Hello, everyone. Welcome to my monthly market roundup and portfolio update. I'm Elvis Picardo, Senior Portfolio Manager with Luft Financial IA Private Wealth. Most equity markets racked up their fourth straight monthly gain in August, even though the month began on a weak note after the downward revision in U.S. jobs numbers. The market recovery was primarily because Q2 earnings were better than expected. Canada's TSX index in particular was one of the best performers last month with a 4.8% gain, beating the S&P 500's 1.9% increase. Now, not many would have expected the TSX to have gained over 15% so far this year, based on the struggling economy and tariff impact. In fact, Canada's current account deficit widened to a record of over $21 billion in the second quarter as exports to the U.S. plunged. As a result, the Canadian economy contracted at a 1.6% pace in Q2, the biggest drop since the COVID pandemic. But here's the silver lining. Canadian consumers are proving to be quite resilient, with household consumption up 4.5% in Q2 despite slowing population growth. Many Canadian companies are not yet passing on higher costs from tariffs to their customers, which is keeping inflation in check. As well, earnings results from Canada's Big Six banks confirmed this resiliency. 5 of the Big Six exceeded earnings expectations as they reported strength in their core businesses and set aside less money for bad loans. In the U.S., speculation about a rate cut this month from the Fed Reserve propelled the S&P 500 to a new high of over 6,500 in the last week of August. But September is going to test this resilience. Investors have turned complacent about downside risks, judging by the low levels of the CBOE volatility index. When the VIX has been at these low levels in the past, we've generally seen a spike in market volatility shortly after. And like us, most market participants are braced for a decline in September, not just because of seasonal trends, but also due to factors we have discussed in previous reports, including market concentration in the US, high valuations, and the potential inflationary impact of tariffs. As I mentioned before, our portfolios have done well in this rally. We have been careful to make incremental changes that ensure continued upside participation while making sure we have measures in place to protect on the downside. For example, in our balanced growth portfolios, we hold 60% in equities and 40% in fixed income and alternatives. When the market rally recently took our equity allocation above the 60% target, we took some gains off the table and allocated those proceeds to fixed income. The yield on a fixed income and alt portfolio is attractive at over 4%, and we think fixed income will do well in an environment where growth is slowing down and interest rate cuts on the horizon. The caveat here is that inflation should continue to be in check. So do check out our website for more information on our models and strategies, and thank you very much for watching. Goodbye.